Senate Banking Committee today ripped into Jamie Dimon, the head of J.P. Morgan, saying that his company put shareholders and the whole financial system at risk. But isn't Congress partially to blame for all of this? Ben has the reality check you won't see anywhere else.
Well, the hearing in front of members of the Senate Banking Committee was supposed to look at the risk still being taken by banks like J.P. Morgan. If you aren't aware, J.P. Morgan just took a gamble that cost shareholders $2 billion. J.P. Morgan's chief investment office made a series of trades which turned out horribly, and it resulted in a loss of over $2 billion in 40 days. According to an article from CNBC, the failed hedge likely involved a bet on the flattening of a credit derivative curve, part of the CDX family of investment-grade credit indices. Might as well be speaking Greek there, right? What that means, though, in essence, is that J.P. Morgan made a series of bets that turned out very, very badly, and it may not be over. If credit spreads soar, J.P. Morgan could actually suffer a $20 billion loss when all is said and done, which is why members of Congress decided to grill CEO Jamie Dimon today.
When you reduce a hedge or hedge a hedge, isn't that really gambling?
I don't believe so, no.
So this transaction that you said morphed, what did it morph into? Russian roulette?
It morphed into something I can't justify that was just too risky for our company.
And that is the real concern here. Too risky for your company, which is one of the nation's finest, largest, well-capitalized banks. If it's too risky for your company, what stops it from being in the future too risky where you lose not $2 to $4 billion, but $50 billion? Create a size that ultimately creates a risk on the bank that takes that bank into the possibility of a run and then ultimately becomes the collective responsibility of each and every American. That's what we're trying to prevent here.
But are they really? After all, while members of Congress will shake their fingers at banks for taking risks that put all of our money and our entire financial system at risk, it was Congress who gave them the keys to this car. It was 12 years ago when Congress repealed a law that had been in place since the Great Depression. In 1933, the Glass-Steagall bill was put in place to create a firewall between commercial banks, which take deposits and make loans, and investment banks, which underwrite securities. With the repeal of Glass-Steagall, commercial banks were now allowed to play a role as buyers and sellers of mortgage-backed securities, credit default swaps, and other explosive financial derivatives. Basically everything that's gone wrong in the financial system, which began to collapse in 2008. Congress knocked down that wall, gave the banks the ability to take the risk, and then becomes outraged when they prove themselves untrustworthy with opportunity that they shouldn't have been trusted with in the first place. But there is more to this story. Look at what just happened with the bailout in Spain. Spain just yesterday approved a 100 billion euro bailout of its banks. That comes to $125 billion. In fact, Spain's prime minister flew to Poland for a soccer game after the bailout was agreed to, saying the matter is finished. But it's not. The banks in Spain are being bailed out. The loan is coming from some euro fund, and the people of Spain, the taxpayers, they're on the hook to guarantee that loan. So what you need to know is this. What's happening in Spain is not just a European problem. It is the world banking problem. If Spanish banks do well, if J.P. Morgan does well, so do executives and so do shareholders. But if the Spanish banks fail, or if J.P. Morgan risks $2 billion or $20 billion and takes a huge loss, who's on the hook? We are, taxpayers, whether Spanish or American. Because at the end of the day, the system that lawmakers have allowed worldwide is one where we have privatized the profits, but we have socialized the losses. And that is Reality Check.
If you'd like to make your voice heard in the story, head over to Ben's Facebook page. You can find it by searching for him, Ben Swan, WXIN.
Podcast with Scott Pierce.
Glass-Steagall was enacted in 1933, shortly after Franklin Roosevelt took office. This important banking regulation law was repealed at the end of the Clinton years. The current problems with the American economy are dramatic, but they're not new. Thinking a little bit about the story of Glass-Steagall can give us some important ideas about how to build a stable and just financial system. It's true that the law of banking and securities is incredibly technical and arcane, But the basic ideas are not that complicated. The stock market crash of 1929 was the opening bell of the Great Depression, which didn't really end in America until the country started to mobilize for World War II. Obviously, there was no one single cause of the stock market crash and the bank failures that followed, but there was, and remains, a broad consensus that two big causes included loose credit and dishonest banking practices. Franklin Roosevelt came to power in the 1932 election with a mandate to regulate the banking and financial systems. The Securities and Exchange Commission was started at this time, and the Securities Act and the Securities Exchange Act were passed into law. These two laws, both of which are still alive and well, dealt with initial public offerings and with the secondary market for stock trading. Glass-Steagall was passed at about the same time as the Securities Act. Glass-Steagall set up a wall between banks that offer commercial banking services and those that are investment banking operations. Before Glass-Steagall, banks could both loan money to businesses and, at the same time, sell shares in these businesses to their investment clients. This was seen as an obvious financial conflict of interest. Glass-Steagall was strengthened in 1956 under President Eisenhower. The Bank Holding Company Act made it illegal for banks to underwrite insurance policies, although banks still could sell insurance. These laws were successful. They worked. But as the decades passed, the banks hungered for higher profits. In 1999, Congress passed the Gramm-Leach-Bliley Act, and President Clinton signed it into law. Gramm-Leach-Bliley repealed Glass-Steagall. Now the banks were allowed, once again, to combine investment and commercial banking under one roof. Now their agents were free to loan a lot of money on speculative ventures, knowing that they could sell these investments to their clients. Deregulation of the financial markets always has the same two consequences: concentrating wealth in fewer hands and economic chaos. The chaos is beginning. With luck, re-regulation will follow.
Juris Vodcast is a production of Nuclear Podcasting. Creative Commons Attribution Non-Commercial No Derivatives.
The Democrats have really done more to destabilize the American economy and to help the big banks on Wall Street than the Republicans have done. I would imagine that the Republicans know a little bit more about finance and markets enough that when someone like Goldman Sachs asks the Congress to change laws as they did in the 90s to do away with position limits on the futures contracts, the Republicans would have said, no way, that's completely inconsistent with any notion of a fair market. But the Democrats, I have a feeling, are just not financially literate enough to say no. And I think that Goldman has very shrewdly positioned themselves with the Democrats, because the Democrats typically, like many NGOs that I've run into, they seem to have a complete inability to comprehend these issues of markets and finance and how it relates to social justice. So under the Democrats, we also saw the repeal of Glass-Steagall.
Glass-Steagall said there's an inherent conflict of interest between the commercial banking side, which is the lending side, and the investment banking side, which is taking an ownership position. And we have to end this conflict of interest by separating these two entities. You can have investment banks and you can have commercial banks, but they have to be separate.
But I would like to see some blunt talk. You know,
on affirmative action?
Well, we had some blunt talk on affirmative action. I don't think the whole debate ought to be about affirmative action. I mean, you know, look at what we've done, for example, with something we're supposed to have a civil rights impact that's largely economic, the Community Reinvestment Act, passed in 1977, over 20 years ago. Now, the Community Reinvestment Act was set up to say to the bank regulators, look, you guys go in and look at these banks and tell them, you got to take some of your money and invest it in inner cities, in neighborhoods, and with people who otherwise would not get it, so they have a chance to build homes, to build businesses, to create jobs, to build neighborhoods. In the 20-year history of the Community Reinvestment Act, 85% plus of the money loaned out under it to poor inner city neighborhoods has been loaned in the 5 years since I've been president.
But discrimination isn't always that obvious. It's sometimes more subtle, but in many ways more insidious. And institutionalized discrimination that's hidden behind a smiling face. Housing agents who say, well, there are no vacancies right now. That you just didn't qualify for the mortgage because your financial credit history wasn't good enough. Last year, the Federal Reserve Board found African Americans are denied credit for homes at twice the rate white Americans are. And it is pervasive. It's what we found in the banking case in Texas, SACU in Texas. Discrimination in lending, discrimination in rendering mortgages. The bank has agreed to change its practices, as you heard from the Assistant Secretary. The bank has also agreed to a $2.1 billion agreement where they'll make $2.1 billion available to families who are low and moderate income across the country for mortgages. About 15,000 low and moderate income people will now be able to buy their own home because of the settlement we announced today. $2.1 billion is by far the largest settlement ever rendered to the federal government to settle a fair housing case. And in closing, the message of today is clear. You've heard it from a number of us now. This is a nation of laws, and this administration will enforce the laws. We'll take questions at this time. Yes, sir.
So this company will end up loaning this money and presumably...
Well, $2.1 billion that would not have been available to families of low and moderate income, low and moderate income families across the country. About 15,000 families we estimate will get mortgages who would not have gotten mortgages otherwise. But aggressively to take a greater risk on these mortgages, yes. To give families mortgages who they would not have given otherwise, yes.
Get the loans at all. They wouldn't have...
They would not have qualified but for this affirmative action on the part of the bank, yes.
Minorities are represented in that low and moderate income group?
It is by income, and is it also by minorities? Yes. With the $2.1 billion lending that amount in mortgages, which will be a higher risk, and I'm sure there'll be a higher default rate on those mortgages than on the rest of the portfolio. That is the remedy that we sought, and the remedy that I would prefer, 15,000 families. This is of a scope so beyond anything that we've really done in the past. We had one settlement just a couple of weeks ago, which was part and parcel of this, which is in the range of about $1 billion. But after that, the closest settlement was $300,000, $400,000, $500,000. So this is of a scope that much surpasses anything we've done in the past.
There was the Community Reinvestment Act, or CRA, passed in 1977 during Jimmy Carter's first year in office. The law increased oversight of financial institutions to ensure that they were giving credit to low-income families.
We're going to make sure those banks do it and they don't discriminate. But the law went overboard. Institutions made loans they probably didn't want to make because they couldn't seem racist. It empowered these community groups who would then bully the banks. Acorn bullied the banks.
Indeed, Acorn, the Associations of Community Organizers for Reform Now, would before long come up with a new tactic, challenging a thrift merger in Illinois, claiming they didn't make the kind of loans that Acorn felt were required under the CRA. A young community organizer named Barack Obama worked closely with the Acorn activists behind the new strategy.
I've been a community organizer and helped design programs at the ground level.
And that strategy worked. Acorn prevailed in court, and soon credit standards were being lowered across the country. While at first Fannie actually resisted buying up some of those shaky mortgages, at the tail end of the Clinton administration, Fannie Mae was told to substantially increase the percentage of those mortgages in its portfolio.
Acorn's attorney was, well, you guessed it, Barack Obama.
You know, I have a background as an attorney. I've represented affordable housing organizations that build affordable housing, something that's a major issue in the district.
Back in the 1990s, they used strong-arm tactics to force banks to give high-risk loans to low-income borrowers with bad credit.
Acorn uses militant tactics. They call it direct action. Sometimes Acorn will actually send people to a bank official's home. They'll scare him, they'll scare his kids. Again, all in an effort to get the banks to make these bad loans.
You've gone back to Chicago and civic rights, civil rights.
Right. You know, I'm currently a practicing civil rights lawyer, which means that I get involved in a whole range of different issues that touch on issues of race.
We look at the subprime mortgage fiasco that's taking place today. Subprime lending started off as a good idea, helping Americans buy homes who previously couldn't afford to. Financial institutions created new financial instruments that could securitize these loans, slice them into finer and finer risk categories, and spread them out among investors and around the country as well as around the world. In theory, this should have allowed mortgage lending to be less risky and more diversified.
Who do you think is to blame for this current mortgage and credit crisis? Who do we see about that?
Well, I think there are a lot of folks who have to take some responsibility. The original idea was a good one, which was, let's see if we can distribute risk more broadly and make it easier to provide loans to people who otherwise might not be able to get them.
Now, up until then, Acorn has managed to fly below the radar, but their dangerous practices are coming back to haunt them and the rest of the country. The economic crisis facing the nation is due in large part to this disastrous decision by financial institutions Fannie Mae and Freddie Mac to buy up risky loans from small banks. But it's groups like Acorn that force those banks to give out those loans in the first place.
What do you think of the Acorn scandal, and how do you think it will affect the election?
The Acorn scandal is a big one. Acorn has received over $760 million in fees alone. This is what we know about, and there's a lot of stuff that's still kind of bubbling up to the surface. But here's an organization that essentially helped strong-arm a lot of banks into making loans to people who couldn't pay them off, so the so-called ninja loans, no income, no job, no assets. At the heart of what has kind of brought about the financial collapse is this rather unconventional idea that we would just loan money out if a person had a pulse.
It is indeed a very troubling report, but it is a report of extraordinary importance, not only to those who wish to own a home, but as to the taxpayers of this country who would pay the cost of the cleanup of an enterprise failure. The analysis makes clear that more resources must be brought to bear to ensure the highest standards of conduct are not only required, but more importantly, they are actually met.
Through nearly a dozen hearings where, frankly, we were trying to fix something that wasn't broke. Mr. Chairman, we do not have a crisis at Freddie Mac, and in particular at Fannie Mae, under the outstanding leadership of Mr. Frank Raines.
And as well as the fact that I'm just pissed off at Ophelia, because if it wasn't for you, I don't think that we'd be here in the first place. And now the problem that we have and that we're faced with is maybe some individuals who wanted to do away with GSEs in the first place, you've given them an excuse to try to have this forum so that we can talk about it and maybe change the direction and the mission of what the GSEs had, which they've done a tremendous job. There's been nothing that was indicated that's wrong, you know, with Fannie Mae. Freddie Mac has come up on its own, and the question that that then presents is the competence that your agency has with reference to deciding and regulating these GSEs. And so I wish I could sit here and say that I'm not upset with you, but I am very upset because, what you do is you give, maybe giving a reason to, as Mr. Gonzalez said, to give someone a heart surgery when they really don't need it.
In addition to our important oversight role in this committee, I hope that we will move swiftly to create a new regulatory structure for Fannie Mae, for Freddie Mac, and the Federal Home Loan Banks.
This hearing is about the political lynching of Franklin Raines.
There is a very simple solution. Congress must create a new regulator with powers at least equal to those of other financial regulators, such as the OCC or the Federal Reserve.
What would make you, why should I have confidence? Why should anyone have confidence in you as a regulator at this point?
Sorry, Congressman. OFAO did not improperly apply accounting rules. Freddie Mac did. OFAO did not try to manage earnings improperly. Freddie Mac did. So this isn't about the agency engaging in improper conduct. It's about Freddie Mac.
And we passed Sarbanes-Oxley, which was a very tough response to that. And then I realized that Fannie Mae and Freddie Mac wouldn't even come under it. They weren't under the 34 Act. They weren't under the 33 Act. They play by their own rules, and I'm tempted to ask how many people in this room are in the payroll of Fannie Mae, because what they do is they basically hire every lobbyist they can possibly hire. They hire some people to lobby, and they hire some people not to lobby so that the opposition can't hire them.
But a concern that I have is you're making very specific, what you have correctly acknowledged, broad and categorical judgments about the management of this institution, about the willfulness of practices that may or may not be in controversy. You've imputed various motives to the people running the organization. You went to the board and put a 48-hour ultimatum on them without having any specific regulatory authority to put that kind of ultimatum on them. That sounds like some kind of an invisible line has been crossed.
Fannie Mae has manipulated, in my judgment, OFAO for years. And for OFAO to finally come out with a report as strong as it is tells me that's got to be the minimum, not the maximum.
Etc. You seem to be saying, well, these are in areas which could raise safety and soundness problems. I don't see anything in your report that raises safety and soundness problems.
Under the outstanding leadership of Mr. Frank Raines, everything in the 1992 Act has worked just fine. In fact, the GSEs have exceeded their housing goals. What we need to do today is to focus on the regulator, and this must be done in a manner so as not to impede their affordable housing mission. A mission that has seen innovation flourish from desktop underwriting to 100% loans.
I find this to be inconsistent and a rush to judgment. I get the feeling that the markets are not worried about the safety and soundness of Fannie Mae, as OFAO says that it is, but of course the markets are not political.
But I have seen nothing in here that suggests that the safety and soundness of an issue, and I think it serves us badly to raise safety and soundness as a kind of a general shibboleth when it does not seem to me to be an issue.
Mr. Raines, $1.1 million bonus on a $526,000 salary. Jamie Gorlick, $779,000 bonus on a salary of $567,000. I mean, this is What you state on page 11 is nothing less than staggering. The 1998 earnings per share number turned out to be $3.23 and 9 mils, a result that Fannie Mae met the EPS maximum payout goal right down to the penny. Fannie Mae understood the rules and simply chose not to follow them. That if Fannie Mae had followed the practices, there wouldn't have been a bonus that year.
And you have about 3% of your portfolio set aside. If a bank gets below 4%, they are in deep trouble. So I just want you to explain to me why I shouldn't be satisfied with 3%.
Because banks there aren't any banks who only have multifamily and single-family loans. These assets are so riskless that their capital for holding them should be under 2%.
Fine.
I think the responsibility that the Democrats have may rest more in resisting any efforts by Republicans in the Congress or by me when I was president to put some standards and tighten up a little on Fannie Mae and Freddie Mac.
I thought it would be neat to celebrate November 12, 1999 as the biggest financial meltdown in my lifetime and give thanks to the politicians who voted for the Gramm-Leach-Bliley Act, or the Financial Services Modernization Act of 1999. First, a little background. The Glass-Steagall Act of 1933 established the Federal Deposit Insurance Corporation to insure bank deposits and required banks to choose between being a simple lender, a bank, or an underwriter, a brokerage. Here we see at Roosevelt's immediate right and left were Senator Carter Glass of Virginia and Representative Henry Steagall of Alabama, the two most prominent figures in the bill's development. In February 1995, Time magazine published Clinton Proposes Banking Reforms. The Clinton administration proposed sweeping changes in the nation's banking system that would permit commercial banks to sell insurance and underwrite securities. Treasury Secretary Robert Rubin outlined the new proposal, which would allow banks to, quote, affiliate, end quote, with Wall Street firms, insurance companies, and other financial service providers. It would repeal several federal restrictions, including the Depression-era Glass-Steagall Act, which forbids banks from underwriting securities or selling insurance. Banks for years have been seeking a repeal of Glass-Steagall. This United States Treasury Secretary Robert Rubin. And this Robert Rubin, who before his government service spent 26 years at Goldman Sachs serving as a member of the board and co-chairman from 1990 to 1992. Here's Time magazine's 15 February 1999 cover praising Robert Rubin, Larry Summers, and Alan Greenspan, the Committee to Save the World, the inside story of how three marketeers have prevented a global economic meltdown so far. The three marketeers convinced Congress and President Clinton to pass the Commodity Futures Modernization Act of 2000. The act's purpose was to protect credit derivatives from being regulated by the U.S. Commodities Future Trading Commission or the United States Securities and Exchange Commission, protect financial institutions from, quote, overregulation, end quote, and position the United States financial services industry to be world leaders in the new century. Larry Summers, President Clinton's U.S. Secretary of the Treasury, lobbied to repeal the Glass-Steagall Act. That's Secretary Summers on the left. President Obama chose Summers to be his director of the White House National Economic Council. In 1999, Senator Phil Gramm lobbied Republicans and Democrats in Congress to repeal the safeguards which the Glass-Steagall Act enacted. Congresswomen like Nancy Pelosi killed Glass-Steagall. Congressmen like Charles Rangel killed Glass-Steagall. Congressmen like James Clyburn killed Glass-Steagall. Senator Arlen Specter, killed Glass-Steagall. Senator Chris Dodd, killed Glass-Steagall. Quote, I have been a member of the Senate Banking Committee since the first day I was sworn into the Senate, almost 19 years ago. I think this effort dates to about 1967 or 1968, more than 30 years ago. This has been an ongoing debate and issue on the part of the banking committees of the Senate and the House, the Commerce Committee, and numerous efforts at the executive branch level. But certainly over the last 20 years, on numerous occasions, this body has enacted reforms to financial services only to watch the legislation die. Senator Chuck Schumer killed Glass-Steagall. As a member of the Banking Committee in the House and the Senate, Schumer worked for a decade to pass the 1999 Financial Services Modernization legislation, which modernizes regulations governing the United States banking, securities, and insurance industries. He played a key role in drafting language to ensure that financial companies serve traditionally underserved areas and has exposed unequal lending practices of banks and predatory lending practices of subprime lenders in minority communities. Congressmen like Patrick Kennedy killed Glass-Steagall. Congressman Elijah Cummings killed Glass-Steagall. Congresswoman Sheila Jackson Lee killed Glass-Steagall. Congressman Steny Hoyer killed Glass-Steagall. Congressman William Jefferson killed Glass-Steagall. Congresswoman Loretta Sanchez killed Glass-Steagall. Congressman Rod Blagojevich killed Glass-Steagall. Congressman David Bonnier killed Glass-Steagall. Congressman Lloyd Doggett killed Glass-Steagall. Congressman Harold Ford killed Glass-Steagall, as did many Republican senators, congressmen, and congresswomen. In a November 1999 Time magazine article titled Bank on Change, we learn that not everyone is happy. Quote, this is horrible legislation, end quote, says bank analyst Lawrence Cohn at Ryan Beck & Company. Quote, it creates a huge potential obligation for U.S. taxpayers, end quote. How's that? Cohn told reporters the new bill would encourage concentration of financial power in a few hands, any of which could topple the system if it failed, forcing a government bailout, which, as we now know, is exactly what happened. On the 12th of November 1999, the Glass-Steagall Act of 1933 was repealed by the Graham-Leach-Bliley Act, or the Financial Services Modernization Act. There's Alan Greenspan, there's Senator Phil Gramm, there's Senator Chris Dodd. Associated Press writer Marcy Gordon wrote an article about the details of the Banking Act Bill Clinton had signed into law in Questions and Answers About Financial Overhaul. Here is the second part of that article. The Associated Press also reported, President signs massive banking bill. In the photo, the president is standing next to Alan Greenspan. Clinton once opposed measure. By Associated Press, Washington. President Clinton signed into law Friday a sweeping measure that knocks down Depression-era barriers and lets banks, investment firms, and insurance companies sell each other's products and provide one-stop shopping for financial services. Quote, this is a day we can celebrate as an American day, end quote, Clinton said at the signing ceremony in a White House auditorium. The audience of lawmakers and senior government officials included Federal Reserve Chairman Alan Greenspan. Praising Congress's bipartisan support for the legislation, Clinton said it is a victory for both free markets and consumer protection. The law will help, quote, make sure that the 21st century economy really works for our country, end quote, the president said. Clinton opposed similar legislation for years, but recently dropped his veto threat after changes were made. Congress passed the law November 5 to open the way for a blossoming of financial, quote, supermarkets, end quote, that sell loans, investments, and insurance. Proponents pushed the legislation in Congress for 2 decades, and Wall Street and the banking and insurance industries poured millions of dollars into lobbying for it in the past few years. At stake is an estimated $350 billion that Americans spend annually on fees and commissions for banking, brokerage, and insurance services. Proponents say the legislation will save customers $15 billion a year, offering them greater choice and convenience and spurring competition. Consumer groups and other opponents maintain it will bring higher prices and jeopardize people's financial privacy. On the 24th of October 1999, the New York Times published Stephen Labatin's report, Deal on Bank Bill Was Helped Along by Midnight Talks. At a fundraiser at Senator Edward M. Kennedy's home, here shortly after 6 o'clock on Thursday evening, President Clinton asked one of his closest friends in the Senate, Christopher J. Dodd of Connecticut, how the talks were going with Republicans over the most important financial legislation since the Great Depression. Mr. Dodd was not optimistic about the bill, which had reached the point of do or die. After 4 days of bitter polemic between Senator Phil Gramm, the Texas Republican who is chairman of the Senate Banking Committee, and administration officials, the two sides were stuck over highly symbolic and racially tinged community lending rules that threatened to rip the legislation apart. The discussions had become so poisoned by Thursday night that Mr. Gramm threatened both the top White House economic advisor, Gene Sperling, and the head of the nation's largest financial services company, Citigroup, that he would pull the plug on the bill, something neither the administration nor Wall Street wanted. Time magazine published a special report titled 25 People to Blame for the Financial Crisis. As chairman of the Senate Banking Committee from 1995 through 2000, Gramm was Washington's most prominent and outspoken champion of financial deregulation. He played a leading role in writing and pushing through Congress the 1999 repeal of the Depression-era Glass-Steagall Act, which separated commercial banks from Wall Street. He also inserted a key provision into the 2000 Commodity Futures Modernization Act that exempted over-the-counter derivatives like credit default swaps from regulation by the Commodity Futures Trading Commission. Credit default swaps took down AIG, which has cost the United States $150 billion thus far. Time magazine continues. President Clinton's tenure was characterized by economic prosperity and financial deregulation, which in many ways set the stage for the excesses of recent years. Among his biggest strokes of freewheeling capitalism was the Gramm-Leach-Bliley Act, which repealed the Glass-Steagall Act, a cornerstone of Depression-era regulation. He also signed the Commodity Futures Modernization Act, which exempted credit default swaps from regulation. In 1995, Clinton loosened housing rules by rewriting the Community Reinvestment Act, which put added pressure on banks to lend in low-income neighborhoods. It is the subject of heated political and scholarly debate whether any of these moves are to blame for our troubles, but they certainly played a role in creating a permissive lending environment.
In my understanding of Christ's teachings, taking care of the poor and the sick were of the utmost importance, and so I was hoping both of you could talk about why you don't think that universal health care is a very important issue to Christians these days. Thank you.
Wow, universal health care. Well, it depends what you mean by take care of the health of everybody. Yes, of course, we're all in favor of that. Everybody should have health insurance. Insurance goes back centuries, the idea. It's a great idea. The question is, who should pay for it? How should this be paid for? What's the most efficient way to make sure everybody gets that coverage? And that's just, I think that's more of a political issue than a Christian religion moral issue.
Yeah, I think there's also the question of, I think the question is often ignored in these contexts is that whenever the government is involved, there's an element of compulsion.
Yes.
And the effect of compulsion is always to strip the virtue out of a transaction. If, Michael, if you and I are walking on the beach and I'm hungry and you have a sandwich, and I say, Michael, I'm hungry, give me your sandwich. And you say, yes, here it is. I say, thank you. Now that's a moral transaction. You feel good about having done something good. I feel a sense of obligation. Maybe someday if I'm doing well, I'll share my sandwich with somebody else. But now here's a third situation. You and I are walking on that same riverbank. I'm hungry, you have a sandwich, and here comes Obama on a horse. He gets off the horse, puts a gun to your head, and says, Michael, turn over the sandwich to Dinesh. And so you do. And then he puts his gun back and he drives away. Now, the outcome is the same. I mean, I have the sandwich. But the moral content of that transaction is completely different. You deserve no moral credit. You didn't give willingly. I don't even feel a sense of gratitude. I feel a sense of entitlement. I feel that you actually owe me 7 sandwiches, but you only gave me 1. So you can see how the whole thing is confused when you bring in the element of coercion.
Indeed. I should point out, just for the other side, their argument is that, for example, if we need to fund a military to protect our liberties from foreign countries, and you say, well, but that's an element of coercion, and you're going to take my taxes at the point of a gun and fund these military, and I don't want to do it, and the government shouldn't do that, then we're not going to have a military, and then we're going to be invaded, and then somebody else is going to put a gun to your head. Either way, there's going to be a certain element of coercion.
But even that doesn't fully work, because the military does protect you and me both, whereas the taking of the sandwich to you, from you to me, hurts you and benefits me. So my point is, any government that robs Peter to pay Paul can obviously keep counting on Paul's support.
Yes, that's the problem.
Okay, let's move to the next question.
Mr. D'Souza, you began with humans are bent or inherently morally imperfect. In the sandwich reference, you presumably believe that Obama should not hold the metaphorical gun to Sherman's head, that he will share that sandwich freely. If humans are not inherently moral, how is this a valid expectation, and why should Obama not hold the gun to Sherman's head, so to speak?
Mr. D'Souza?
Because the guy holding the gun is no better than the guy to whose head he's holding it to. So in other words, sure, Michael Shermer may be a selfish guy who wants to keep his sandwich. But nevertheless, let's consider the motives of the guy with the gun. Is he contributing his own sandwich? No. He's taking Michael Shermer's sandwich and giving it to someone else and then proclaiming himself to be a morally wonderful human being. Look, I'm not denying the core principle involved here, right? I'm simply saying that here we are as a country, and for 2 centuries we've had people pulling the wagon. And we recognize, and I would agree, that there is a group of people, and you can disagree about how many, but I would say about 10% of people who are weak and disadvantaged and need to sit in the wagon and have the rest of us pull that wagon. Okay? Now, again, you can disagree about how many people should be in the wagon, but that number of people has been increasing considerably. This was kind of what Romney's getting at, that at some point there are more people in the wagon than there are pulling. And then people who are pulling begin to think, well, maybe I should stop pulling and get in the wagon. It's kind of nicer in the wagon. And what my criticism of Obama is, instead of saying, listen, I really want to thank the people who are pulling the wagon, he goes, the people who are pulling the wagon are greedy, selfish, and materialistic. And the people sitting in the wagon are wonderful. He is morally demonizing the wagon pullers and championing the superior morality of the guys who are sitting in there. And all I'm saying is this is an inverted morality. The guys who are actually contributing to help the disadvantaged, these are the sacrificial people of our society, and they're the ones who deserve a little more credit.
Next question, please.
Hello, I'm from the government and I'm here to help.
Well, I am the government and I'm really busy now. You have no idea how hard it is to be president.
I always like to say, politics is not a bad profession. If you succeed, there are many rewards. If you disgrace yourself, you can always write a book. So, what you doing here?
I'm redistributing the wealth. I learned in school spreading the wealth is good for everyone.
Well, I learned from real life that it's not. What about the guy you're taking money from?
Okay, so it's good for 75% of the people. Isn't taking money from one person to make 3 others happy a good thing?
No, it's a very bad thing. In fact, there's a word for it. It's called theft.
But it will better the lives of 3/4 of the people.
Actually, it will make life worse for 100% of the people. And we call that socialism.
I can't stand how all you conservatives say socialism, like it's a dirty word.
That's funny. I feel the same way about how you liberals use the word capitalism. How about giving me 5 minutes and let me tell you a story, Jelly Bean?
No thanks. I'm good.
Well, they're mine, and I'm happy to share some.
That's all right, Ron. As I see it, I'm already entitled to at least half of them.
That's a good one. Not long ago, there was a college professor in Texas, and he...
Oh, can you make it Southern Methodist? I'm gonna have me a presidential library there one day.
Sure.
Yeah, right. When I'm president, I'm gonna have the biggest presidential library in history.
Yeah, because yours is going to be the only one with an adults-only section. Oh, gosh. I just cracked myself up.
So, the professor was teaching one day when one of his students came up with what he thought was a brilliant idea.
Professor, on behalf of the entire class, I would like to go on record and say that socialism works. It gets rid of the upper and lower class. No one is rich and no one is poor. We would all work hard and we would share everything.
Oh, man. Yeah, go us.
Sounds wonderful. We'll be able to have private jets, right?
Don't think it'll work very well.
I feel what you're both saying, and I love you for it. You are both very intelligent women.
You pig!
Ow! It wasn't me.
Socialism, huh? All right, let's do a little experiment. All grades will be averaged for the next test, and everyone will receive the same grade.
Oh, that sounds good. I mean, the best students will still have pretty good grades, and now nobody will feel like a failure.
Read my lips. No one will be a failure. Right, son?
You got it, Pop.
This is great news. I better text my buddy Carl. Red Rover, Red Rover. No need to send those answers over.
Yeah, you probably would have got caught anyway. I wish I had that on tape.
So the time came to put the experiment to the test. It didn't seem like much changed. Maybe one or two had doubts.
It's a very good question. Very direct, and I'm not gonna answer it.
Here, I smoked it, but I never inhaled.
I know. You're not a criminal, right?
I have inhaled and exhaled everything.
Well, class, the results are in. Everyone got a B.
What?
All right, go us!
Bill, this is all your fault. I demand a recount.
Hey, this is perfect. My average just went up. No child left behind, right?
What are you doing? I'm very confused.
The students who had studied hard were upset, while the students who had studied very little were happy. But when the next test rolled around, the students who had studied little studied even less, and the ones who had studied hard decided, since they couldn't make an A, they wanted a free ride. So they also studied less. The second test average was a D. No one was happy. When the third test rolled around, the average grade was an F.
I like the color red because it's a fire, and I always see myself as being on fire.
The scores never increased as bickering, blame, name-calling all resulted in hard feelings, and no one would study for anyone else. To their great surprise, all students failed.
If you think I have worked all these years to let Herb ride on my coattails,
I did
and
not
you,
cause
you,
this.
are
This
you
is
kidding
not
me?
my fault.
I can't make a B on my own.
You see, class, socialism doesn't lift the bottom up. It tears everyone else down.
That was a stupid idea. I could have told you that on tape. Wait, I think I did.
Who came up with this idea anyway?
I'll tell you who came up with it. The new kid.
Ooh, let's get him.
Let me be clear.
Get him!
Never mind.
So, what did you think, Chief?
Interesting story, but I don't see it the same way.
Well, just remember, government's first duty is to protect the people, not run their lives or steal their ambition and dreams. A government big enough to give you everything you want is a government big enough to take away everything you have.
The crisis of credit, visualized. What is the credit crisis? It's a worldwide financial fiasco involving terms you've probably heard like subprime mortgages, collateralized debt obligations, frozen credit markets, and credit default swaps. Who's affected? Everyone. How did it happen? Here's how. The credit crisis brings two groups of people together, homeowners and investors. Homeowners represent their mortgages, and investors represent their money. These mortgages represent houses, and this money represents large institutions like pension funds, insurance companies, sovereign funds, mutual funds, etc. These groups are brought together through the financial system, a bunch of banks and brokers commonly known as Wall Street. While it may not seem like it, these banks on Wall Street are closely connected to these houses on Main Street. To understand how, let's start at the beginning. Years ago, the investors are sitting on their pile of money, looking for a good investment to turn into more money. Traditionally, they go to the U.S. Federal Reserve, where they buy Treasury bills, believed to be the safest investment. But in the wake of the dot-com bust in September 11th, Federal Reserve Chairman Alan Greenspan lowers interest rates to only 1% to keep the economy strong. 1% is a very low return on investment, so the investors say, no thanks. On the flip side, this means banks on Wall Street can borrow from the Fed for only 1%. Add to that general surpluses from Japan, China, and the Middle East, and there's an abundance of cheap credit. This makes borrowing money easy for banks and causes them to go crazy with leverage. Leverage is borrowing money to amplify the outcome of a deal. Here's how it works. In a normal deal, someone with $10,000 buys a box for $10,000. He then sells it to someone else for $11,000. For a $1,000 profit, a good deal. But using leverage, someone with $10,000 would go borrow $990,000 more dollars, giving him $1 million in hand. Then he goes and buys 100 boxes with his $1 million and sells them to someone else for $1,100,000. Then he pays back his $990,000 plus $10,000 in interest. And after his initial $10,000, he's left with a $90,000 profit versus the other guy's $1,000. Leverage turns good deals into great deals. This is a major way banks make their money. So Wall Street takes out a ton of credit, makes great deals, and grows tremendously rich, and then pays it back. The investors see this and want a piece of the action, and this gives Wall Street an idea. They can connect the investors to the homeowners through mortgages. Here's how it works. A family wants a house, so they save for a down payment and contact a mortgage broker. The mortgage broker connects the family to a lender who gives them a mortgage. The broker makes a nice commission. The family buys a house and becomes homeowners. This is great for them because housing prices have been rising practically forever. Everything works out nicely. One day, the lender gets a call from an investment banker who wants to buy the mortgage. The lender sells it to him for a very nice fee. The investment banker then borrows millions of dollars and buys thousands more mortgages and puts them into a nice little box. This means that every month he gets the payments from the homeowners of all the mortgages in the box. Then he sicks his banker wizards on it to work their financial magic, which is basically cutting it into 3 slices: safe, okay, and risky. They pack the slices back up in the box and call it a collateralized debt obligation, or CDO. A CDO works like 3 cascading trays. As money comes in, the top tray fills first, then spills over into the middle, and whatever is left into the bottom. The money comes from homeowners paying off their mortgages. If some owners don't pay and default on their mortgage, less money comes in and the bottom tray may not get filled. This makes the bottom tray riskier and the top tray safer. To compensate for the higher risk, the bottom tray receives a higher rate of return, while the top receives a lower, but still nice return. To make the top even safer, banks will insure it for a small fee called a credit default swap. The banks do all of this work so that credit rating agencies will stamp the top slice as a safe, AAA rated investment, the highest, safest rating there is. The OK slice is BBB, still pretty good, and they don't bother to rate the risky slice. Because of the AAA rating, the investment banker can sell the safe slice to the investors who only want safe investments. He sells the OK slice to other bankers, and the risky slices to hedge funds and other risk takers. The investment banker makes millions. He then repays his loans. Finally, the investors have found a good investment for their money, much better than the 1% Treasury bills. They're so pleased they want more CDO slices. So the investment banker calls up the lender, wanting more mortgages. The lender calls up the broker for more homeowners, but the broker can't find anyone. Everyone that qualifies for a mortgage already has one, but they have an idea. When homeowners default on their mortgage, the lender gets the house, and houses are always increasing in value. Since they're covered if the homeowners default, lenders can start adding risk to new mortgages, not requiring down payments, no proof of income, no documents at all. And that's exactly what they did. So instead of lending to responsible homeowners, called prime mortgages, they started to get some that were, well, less responsible. These are subprime mortgages. This is the turning point. So, just like always, the mortgage broker connects the family with a lender and a mortgage, making his commission. The family buys a big house. The lender sells the mortgage to the investment banker, who turns it into a CDO and sells slices to the investors and others. This actually works out nicely for everyone and makes them all rich. No one was worried because as soon as they sold the mortgage to the next guy, it was his problem. If the homeowners were to default, they didn't care. They were selling off their risk to the next guy and making millions, like playing hot potato with a time bomb. Not surprisingly, the homeowners default on their mortgage, which at this moment is owned by the banker. This means he forecloses and one of his monthly payments turns into a house. No big deal. He puts it up for sale. But more and more of his monthly payments turn into houses. Now there are so many houses for sale on the market, creating more supply than there is demand, and housing prices aren't rising anymore. In fact, they plummet. This creates an interesting problem for homeowners still paying their mortgages. As all the houses in their neighborhood go up for sale, the value of their house goes down, and they start to wonder why they're paying back their $300,000 mortgage when the house is now worth only $90,000. They decide that it doesn't make sense to continue paying, even though they can afford to, and they walk away from their house. Default rates sweep the country, and prices plummet. Now the investment banker is basically holding a box full of worthless houses. He calls up his buddy the investor to sell his CDO, but the investor isn't stupid and says, no thanks. He knows that the stream of money isn't even a dribble anymore. The banker tries to sell to everyone, but nobody wants to buy his bomb. He's freaking out because he borrowed millions, sometimes billions of dollars to buy this bomb, and he can't pay it back. Whatever he tries, he can't get rid of it. But he's not the only one. The investors have already bought thousands of these bombs. The lender calls up trying to sell his mortgage, but the banker won't buy it, and the broker is out of work. The whole financial system is frozen, and things get dark. Everybody starts going bankrupt. But that's not all. The investor calls up the homeowner and tells him that his investments are worthless. And you can begin to see how the crisis flows in a cycle. Welcome to the crisis of credit.
The $100 bill. The most counterfeited money denomination in the world. Keeps the globe moving. This is what 10 grand looks like. Enough for a great vacation or to buy a used car. Approximately 1 year of work for the average human on Earth. You're looking at $1 million. Not as big a pile as you thought. Still, this is 92 years of work for the average human being. This is $100 million. Plenty to go around for everyone. Fits nicely on a standard size pallet. $1 billion. You'll definitely need some help robbing a bank. Now we're getting serious. And the Mac Daddy, $1 trillion. Now when the US government speaks about a $1.7 trillion deficit, this is the volumes of cash the US government borrowed in 2010 alone to run itself. Now keep in mind, it is double-stacked pallets of $100 million each, full of $100 bills. Now you're going to need a lot of trucks to freight this around. If you spend $1 million a day since Jesus was born, you would not have spent $1 trillion by now. Unless the US government fixes the budget, US national debt will top $15 trillion by Christmas of 2011. But the numbers get much worse. The US unfunded liabilities has reached $114.5 trillion. Now to the right you can see the pillar of cold hard $100 bills that will dwarf the World Trade Center and Empire State Building. Both at one point were the tallest buildings in the world. The $114.5 trillion super skyscraper is the amount of money the US government knows it does not have to fully fund the Medicare prescription drug program, Social Security, military, and civil servant pensions. It is the money the USA knows it will not have to pay all its bills. Now, if you live in the USA, this is your personal credit card bill. You are responsible along with everyone else to pay this back. The citizens of the USA created the US government to serve them. This is what the US government has done while serving the people.